It's becoming obvious now that the government and the administration are going to do whatever they can to prop up the housing market at the detriment to consumers and the working class. And this is a real estate revival or survival based on where you are, if you're an owner or if you're a renter. And we're going to jump into the data of why this could get a lot worse over the next couple months, even with the government stepping in, trying to prop everything out, including giving handouts to basically everyone that they possibly can. So let's dig in because the builders are freaking out. They're going to the administration and they're saying, I need help. And the businesses are doing it too. So look, right now we are in an absolute affordability crisis. This is a chart of the US home price to income ratio, which has surpassed the great financial crisis numbers. We are less affordable today than we were at the peak of the great financial crisis, at the peak pricing at that point in time. And wages have basically stalled out. For young people, the unemployment rate is 9%. It's moving up across the board, and it's becoming really difficult to live as the consumer is just choking on tons of debt between student loans, car loans, credit card loans, and having up to 50% of their income or even more going to rent or mortgage payments. And so this is plaguing the current administration with their ratings. I know a lot of people don't care about the ratings, but they have to do something to respond to this affordability crisis because we're seeing the wealth gap expand rapidly, and this absolutely impacts the housing market, which is why you're watching here today. And frankly, this price income ratio, if you're looking at it as an investor, this shows you it's one of the worst times ever to purchase in history because you have to be thinking, who is the next buyer of this asset when it comes time for them to be able to purchase and the investor to sell? Who is the next buyer? Because in 30 years from now, people aren't having as many kids. We have the silver tsunami. A lot of people are passing away. There's a lot of issues that are coming along the pipeline that is going to make this chart basically revert back to the mean. And if we have mean reversion, we could see a 31 to 42% decline in home prices, according to the data that I am tracking here in Florida. And that's for Florida specifically. Of course, Texas is having issues, Arizona is having issues, and across the country, we're starting to see the pendulum swing from a very strong seller's market and into a buyer's market. So this data comes from Goldman Sachs. Now, look, this is a really interesting chart. My favorite thing about this chart is that the median home buyer age rose from 39 to 59 in 2025. So 20 years over 20 years. So it's basically the same people buying the houses just 2 decades later. And look at this, the first time home buyer age has jumped from 29 years all the way up to 40. So people are delaying having kids, buying a house, and starting their life. And it now takes often two incomes to be able to get to that $120,000, $150,000 mark to be able to purchase a home. So it's really challenging for people to get by. And so, frankly, the typical repeat buyer is now 62, which is a record. The first time home buyer is a record, and the repeat buyers is a record. So all buyers are just basically they're priced out. The younger buyers are completely priced out, and this will have an impact down the line of who the buyers are going to be in 20 to 30 years if you're an investor looking to purchase and move forward. And if you're a buyer just looking to live in the house, let's dig into what the economic plans are for the 50-year mortgage and all these other things that are going on in the market to extend this run as far as possible, because that is what the administration hopes to do, especially through midterms, to make sure the economy stays propped up long enough so they can continue to get votes. And by the way, this is no different than what the Democrats do. I'm not picking on either side, but I will pick on Pulte because he is the godson of the original Pulte who built Pulte Homes back in the 1950s. And I can tell you this, I don't think he has any understanding of economics, finance, or mortgage, even though he's been in the building industry for a very long time. It seems like he does not know what's going on. So he actually proposed to Trump this 50-year mortgage idea because he thinks it's going to make it more affordable. It does not increase affordability. Let me be clear. That is just changing the loan term. Changing a loan term does not make something more affordable. It makes it more accessible for somebody who's on the margin of being able to purchase by $100 or $200 off a month to be able to purchase. But the reality is it's not more affordable because the amount of interest that they have to pay and the less principal pay down that they have on the equity side through the amortization schedule is so small. So they're not building equity and they're paying more interest. And that does not mean better affordability. It means that they're giving access to these fringe buyers that are now able to purchase should this go through. Obviously, there was a massive backlash on this on social media because this was not prepped. It seems like it was just kind of thrown out there as spaghetti against the wall to see what can stick to actually help solve this problem. And again, this is really poor management. I mean, they should be vetting out all of these ideas before making any proposals. They shouldn't just be sitting around and just proposing anything at any time. I mean, this is the United States here. So I think this was a misstep. I do appreciate the administration looking for ways to improve affordability, but this is not what this plan or proposal does. It would help the benefit of the builders and the developers and the banks and getting more interest. There's another proposal that came out here. Again, this is just changing the term 15-year car loan. Okay, a lot of cars last only 12 years. So it's kind of interesting. When you think about doing a loan to somebody, obviously you want the useful life of it to probably be half of what the loan term is going to be. I mean, the loan term to be half of what the useful life will be. If a car only lasts 10 years, then you probably only want to have a 5-year term. Same thing for a house. And a lot of things in a house, which is not talked about enough, is there is something called repair drag, which just ties up a lot of cash to upkeep the property. These are physical assets. And so the question is, why don't we just make everything just massive number of years, right? Why not a 200-year student loan? Why not a 100-year student loan? Why not a 100-year car loan? Why not a 100-year mortgage if you think the house will last that long? People who have brand new construction houses, their house barely lasts 3 years before it starts having major issues. So this to me, again, is just a play to try to get people who are on the fringe to be able to purchase at the peak of the market and bail out, frankly, the builders who are screaming bloody murder at this point because they've had to drop prices and add incentives of up to 22%, according to the data that we've already seen. And that data is usually on a 3-month lag. So look, we do need a better affordability. I appreciate it. This is not the path to be able to make that happen. So look, this is a great image that, 5,000-year mortgages, right? Just pitching reasonably. So affordable, what does that mean? Reasonably priced and within one's financial means. Look, if you can't afford a 30-year mortgage, you probably can't afford a 50-year mortgage, and it'll be with you your entire life unless you move or refinance. So in other words, a person can pay for it without excessive financial hardship. It could very well be that there's going to be excessive financial hardship because when we run the numbers and we look at the math over a 10-year period on a $500,000 loan, you only pay down $18,000 in principal payment. And most of your payments are interest that's going to the bank. Well, you're going to have more on a $500,000 house. You're going to have more than $18,000 in repairs. So you're going to be underwater in that purchase. You basically are renting at this point, but you're renting from the bank and you're having to pay the HOA, pay the taxes, pay the insurance, pay everything on the house. The bank really owns the house at this point in time. I do appreciate more options. I think more options is better, but creating more accessibility to the fringe buyers at the peak of the market, I don't think is a good option for those folks. So please do the math. If this actually comes to fruition, be careful. Really talk to people about what the financial outcomes are, whether this is actually a true benefit for you and your family. And a lot of people, they do need the automatic savings. I'd rather see the money go down to pay the principal balance than to have that extra $100 pop out and just be immediately spent and just continue to be loaded up with debt at an interest rate like today. This was one picture that I loved, right? This is 50 years from now. I mean, if you're 50 years old and you're getting a 50-year mortgage and you're planning to live over 100, the average age of a male is like 76 years old. So obviously you're going to pass away and pass it down, and you're only going to have 24 years left on your mortgage. And so things could really change by that time period. So, finally paid it off. It's like a whole different space age at this point by the time you actually pay it off. So again, this is kind of like a dystopian concept. Why not just change the loan terms for everything so that way we can afford it, right? Doesn't make any sense when you think about it for other assets. And the negligible benefit for the consumer is insane. So this is a chart that came out from Compass. It says savings for a 50-year mortgage due to higher interest rate on a long-term loan, because the difference between a 30-year and 50-year mortgage is 20 years. The bank's going to have to charge you more for that additional risk for those 20 years. So the math shows us that it's going to be about at least 50 basis points higher, or 0.50% higher than a 30-year mortgage. Well, this is going to make your savings basically negligible. And you can see this from this chart. You can see 30-year fixed at 6.3, 50-year fixed at 6.8. You're saving $116 a month. I mean, if that is the difference between a 30 to 50-year mortgage and you're only saving $116 a month, you should not be buying a house. That's my personal opinion. I understand some investors will say, well, I'm going to get more cash flow, et cetera, et cetera. I'll take the cash flow now. I have no problem with this. I'm a cash flow investor. I get it. Okay. If that's your strategy, wonderful. I'm not sure 6.8% is a really good rate for you if you're an investor at this point in time. Investor loans usually have higher rates of return, and they probably will have an even higher rate than 50 bips from the 30-year to the 50-year mortgage for investors. So we need to see what the numbers actually come out with, run the amortization schedules, and then share that information so that way the consumer and investors have the appropriate information. Overall, again, I think the administration is just trying to find a path to fix this issue. But again, changing a loan term, such as the duration of the loan or the term of the loan, is not the way to make things more affordable. So look at this. Here's the math on a $400,000 one. 30-year fixed at 3.75 is 200. This one's also saying $127. So all the math is coming out to be about the same, around $100 to $200, $150 savings per month. And again, if you're going to add 20 years of debt to save a couple $100 a month, that's not affordability. That's desperation dressed up as innovation. So what do we actually need? I think we need to have more supply of income of houses that people can actually afford. So not building stuff in $500,000, $700,000 price range, but building stuff at the 150 to 250 price range. But the builders don't want to do this because there's not enough profit margin in them. And I don't think the government should be giving handouts for the builders to go build this. That's the opposite. That's like that's welfare for builders. We don't want that. One of the other things that the administration is looking at is Fannie Mae said they're set to drop their 620 credit score minimum. This is stuff that we saw back in 2008. Okay, you're trying to change the terms, trying to make everything a little bit more loose so that way these people on the margin that can barely afford to rub two nickels together can come in and purchase, and they get screwed over because they're buying at the peak of the market. I think this is horrible. So now they're saying the mortgage giant will instead use its own analysis of risk factors. Officials say they're easing barriers to borrowing. This is not what this is. This is them trying to bail out the builders who are struggling more, which is sad because the builders still have good profit margins. Instead of earning 25%, they're owning 18%. Who cares? I mean, that's plenty of money for them at this point in time. I do believe in a capitalist society and economy. However, this is just welfare for builders at this point by trying to change all the standards at the end of the market to continue to drive prices higher and bail out the builders as they get out of this inventory in specific areas that they massively overbuilt. So it's just the latest in a series of policy changes aimed at creating home ownership opportunities in the United States. We're not designed for home ownership. We're designed for mortgage ownership. And unfortunately, this comes from homes.com. So what do you think about this? I'd love to hear from you. Do you think dropping the credit score minimum during this time period is a smart thing to do from a risk perspective if you're Fannie Mae? Please drop in the comments with what you think about this. What do you think about them creating a 50-year mortgage? I'd love to hear your thoughts on that as well. And frankly, it's like over the weekend, they just got together and said, what are like the top 10 ideas where we can just hand out checks to everybody that's struggling, where we could just continue to grow this economy, right? Because we have this huge debt problem, $38 trillion, and it continues to move up every single month. What are we going to do with all this debt cycle? Well, Trump and the administration said, we're just going to outgrow the debt problem. This is a really bad idea, and Ray Dalio has come out and said this is going to get a lot worse, and something will cause the market in the stock market to crack. That will mean have huge consequences for the housing market. So look, what do you think about this? They're now saying we're going to use the tariff money to come in and just give $2,000 of a rebate check to certain people under, whatever, 150,000. Do you think this is a good idea? Because this is one step away from socialism. You're taxing everyone and then giving another group of people just straight up checks, no strings attached, just here's some money. And there's going to be a lot of people who have specific incomes who are like super wealthy that don't have that income that are still going to get these checks. So it could be getting in the hands of the wrong people in terms of implementation. I'd love to hear what you think. Do you think any of these ideas are good, or do you think there's other people out there who have way better ideas on how to actually help afford this affordability crisis that we're in? And frankly, this is causing internal crisis. So again, I don't think there's any vetting of what's going on here. There's no diligence on the proposals that are coming through. White House officials are apparently furious with Bill Pulte. The FA director who talked directly to the president about this 50-year mortgage idea. And so it wasn't vetted, and they just posted it on Truth Social. And now a lot of people, even from within their own party, are upset at these proposals. So again, I don't think anybody is vetting these ideas before they get out there. And that's a huge problem for the market and will continue to be a huge problem moving forward if they continue this approach, because they're going to lose a lot of people who are supporting them because their policies are not well thought out. And the affordability crisis is everywhere. So this came out from Goldman Sachs. Americans can't afford their cars anymore, and Wall Street is worried. Goldman Sachs president warns it's not going to be pretty as default fears mount. And we continue to see people stop paying their credit card first, then they stop paying their car loans next, and then they stop paying their house. And we're already seeing late payments for rent start to tick up, and we're starting to see defaults across the board, especially with student loans. About 15% of student loans are now in default at this point. So the affordability crisis continues to move forward, and this does impact housing because when people can't pay their credit cards, they can't pay their student loans, they can't pay their car loans, that impacts their credit score and their ability to purchase property down the line. And another overlaying factor that's not looking great is the layoffs. The number of layoffs that have been announced in 2025 is pacing basically as bad as it was during 2008 and 2009, almost 2020. And so I expect to continue to see more layoffs going into the end of the year and the labor market continuing to weaken. This is going to impact housing. If you don't have a job, obviously you can't purchase a house. If you see other people getting laid off, you're not going to make the largest financial purchase of your lifetime by buying a house. So this can really change very quickly. The only thing that's really been propping up the entire market is that the stock market is still doing phenomenally well. And that's part of the reason why this higher age category, 61 plus, which is the baby boomers, they're trading houses basically back and forth to each other at this point from the median age home buyer. And it's because their stock portfolios have been crushing it. I mean, we're already up, I think like 14% this year on the S&P 500 and the QQQ. So this is going to be really impactful for the market. If we see the stock market crack, we see the labor market start to crack. I definitely think we could see lower interest rates. However, it will not be enough to save housing because obviously you have to be employed to be able to purchase. We're also starting to see rents drop due to oversupply and accidental landlords. I can tell you this here in Florida, we've already seen rents drop about 15 to 20% here in Jacksonville, depending on the area, because there's so much inventory coming on. There's accidental landlords. So when somebody is unable to sell their house, they then turn around and see if they can rent it, and that adds to the rental supply. We also have a ton of multifamily that's coming onto the market, not just the stuff that's already been produced, but more that's coming onto the market, that this supply will eventually drive down the rents. There's people dancing on the side of the street saying 3 months free rent. And I think it's a good time if you're a tenant to renegotiate your terms as much as humanly possible if you're in the Sun Belt area and you're dealing with an area where there's a ton of supply. So this is a good thing. I think we need to see rents drop. We need to see prices drop. We need the government to stop intervening and trying to prop everything up. That is actually the cause of why we have this affordability crisis. And what would fix this, for example, is if the Fed just like sold the $2.3 trillion of mortgage-backed securities they have on their balance sheet to just let the market be normal and reset so the next generation can buy in. This is an insane chart. This is the Case-Shiller Real Home Price Index. As you can see, we're past the prior peaks. We can see a period where World War II starts, reduced supply drives up prices, but we still virtually had no price gain in 50 years following World War II, which is wild. Look at this period where we're just like going up. Here's the bubble, 06, 07, and then we had a big correction back down to back to reality, and now we're just right back where we started. And obviously we could see some sort of mean reversion here moving on out. That'll be very likely coming up. And this is, again, so they're projecting a little bit in 2028, but we do think that prices will come down moving forward. Another chart, this is existing homes median price. Look at that, 418,000. So if you bought pre-2020, I mean, your house went from 275 to 420 within a very short period of time. Those are massive gains, but that's really where the affordability crisis, it started back in 2017, 2018. We actually thought we were going to have a downturn at the end of 2019. And then obviously the events of 2020 to 2022 with the zero interest rate policy. That's why prices went up. By the way, it was literally just because the government put rates to zero. And obviously people are going to go out there and buy really big assets with a ton of debt at super low rates when you have that type of environment, especially private equity. That's why we saw this private equity boom in housing as well. And here's the reality. We are number two in homes with mortgages from a ranking perspective. And we're number 26 for total homers, number 20 for home ownership rate. So what this means is that we are a country that is designed to maximize mortgage ownership, not home ownership. And we can see this when we compare ourselves to other countries. And so I think this is pretty much what the 50 year would do. It would just create more homes with mortgages. It would not necessarily, increase our home ownership rate. I think actually a lot of people who get a 50-year mortgage, if they're that slim and on the fringe and they're just a retail buyer, not an investor, I think a lot of those will have a significantly more risk and will end up defaulting at some point during their loan term just because they're more of the fringe type borrowers. So look, I want to hear from you. Do you think the government should keep pumping assets and coming up with these spaghetti that they just throw at the wall and see what sticks and just keep proposing? Or do you think they should do diligence, deep diligence before making proposals to the public and getting that out there? What do you think happens if the government lets the market actually reset? Probably never will let that happen. But what if they did? How far do you think prices would fall in real estate if the government did not step in and make these changes? And are you seeing in your area dropping prices? Here in Jacksonville, Florida, in some neighborhoods, we're already seeing 10 to 15% declines. A lot of areas around Florida have already seen 10%. 10% is a correction. 30% drop from the peak is a crash. I am expecting to see a crash here in Jacksonville in some areas around the Sun Belt, but this doesn't happen overnight. Again, this takes years for it to play out. It's just a slow trend upward of supply and then a slow trend downward of price until we get to some sort of normalized equilibrium where the buyer can now afford these prices. And I don't think, unfortunately, that wages will keep up to be able to change this narrative. Would love to hear from you what you're seeing on the ground. Comment below your opinion on what the government is up to and trying to pump these assets. And as always, if you want to follow me on Substack, I talk about things I can't talk about on YouTube. You can go into the comments below. If you need a top agent in your area, I've had tons of people reach out to me. I'm connecting them with the top agents. We even had a few that have gone under contract with these top agents. They're going to look out for you. Especially if you're in Florida, I've got the best of the best, but no matter where you are, I can help you interview and make sure you have the right agent for you. So reach out or email me and I'm happy to assist you. See you guys soon.